Welcome to State of the Market, a podcast that is brought to you by the Business Weekly, a publication under the Zim Papers stable. My name is Kuzanai Sharara and I will be your host. Today our focus is on the latest measures to stabilize the exchange rate. And to help me break that down, I'm joined in the studio by economists Gladys Shumba-Miri Mutsopotsi. Gladys, welcome.
Welcome, Kuti.
And I'm also joined in the studio by the Business Weekly resident economist, Tapiwa Mangwiro. Tapiwa, welcome.
Welcome, Kuti.
Gentlemen, lady and gentlemen, when the new RBZ governor, Dr. John Mushayavanu, came into his reign, he had so much hope, so much expectations, so much weight according to what Zimbabweans were expecting. They were expecting for change. They were expecting for price stability, which is one of the mandates of the Reserve Bank of Zimbabwe. They were expecting exchange rate stability as well, which is another mandate of a central bank in the country. However, a few months down the line, we saw the devaluation of the Zimbabwean gold, which is the local currency, by close to 43%. Something that we did not expect that would happen soon. So maybe let me start with you, Gladys. How did we get where we are?
Thank you very much, Kudzi. When the new governor came into office, we experienced the introduction of the new currency. And there was so much expectation and hope by the transacting public that maybe things were going to improve and get better. We thought that maybe there was going to be price stability through the introduction of the new currency. But instead, we have experienced a resurgence, or rather an increase in our inflation. But yet we were expecting maybe a reduction in our inflation. So the resurgence of inflationary pressures is what has brought us now to this situation, and it has also been worsened by the devaluation of the ZiG.
So coming to you, Tapiwa, Gladys spoke about the resurgence of inflation. In your view, what has caused the resurgence of inflation as well as the currency and price instability that we were witnessing in the market?
I would put it to two things. The first one is because we are doing the same things once again. The things that we've always complained about in the past 5-6 years. We see that we have an expansionary fiscal policy, which is one of the reasons why I think inflationary pressure is coming on. And in terms of price volatility, I think the central bank is also part to play because of its own measures that it is taking on the forex market.
Before maybe to you, Gladys, before the introduction or before the devaluation of ZiG, we had seen that the gap between the interbank market, and the parallel market had gone up to close to 100%. That's the premium. Now the Reserve Bank has come in with measures. First, it was the devaluation, and then there are other additional measures that we might talk about later. But just looking at the devaluation itself, do you think this measure is the right measure in terms of stabilizing the exchange rate?
Thank you very much, Kudzi. I don't think that this measure is going to stabilize our exchange rates. Number one, the transacting public here does not have confidence in the local currency. So it is actually issues to do with currency stability and the issues of confidence. The transacting public does not have confidence in using the local currency. So I don't think it is going to bring about the expected exchange rate stability. We have already seen the response by the business community. If you go into the local shops, prices have already increased. I think they have tripled soon after the announcement of the devaluation. So I don't think at this juncture it was the right measure to do.
We have heard a lot of people talk about the loss of confidence, lack of confidence in the local currency. What do you think has caused, maybe as a follow-up, Gladys, what do you think has caused this lack of confidence within our monetary system, within our local currency? Why have Zimbabweans lost confidence in their own money, in all the efforts to reintroduce? I think this is the 60th time from when we have tried to introduce a local currency. What has caused this loss of confidence?
If we go back to the 2008-2009 era, people had made a lot of investments in financial institutions and in various businesses, and people lost their value. Their stored value, they lost their investments because of the introductions of these local currencies. So it is because people are no longer having confidence in the local currency because of what has happened in the past. The other issue is also to do with inconsistency in the policies by the central bank. So people don't know what to plan next. I was coming from an insurance forum where people were in a meeting discussing how to introduce a local ZIG insurance product. And in the midst of that particular meeting, they hear of the new policy of devaluation. And all those discussions, they went to nothing. So all these policy inconsistencies also cause people to lose confidence in the new currency.
Yeah, I think given the instability that we witnessed with the ZIG, and I think the central bank admitted that there was instability that needed to be dealt with, both in terms of pricing, because we were seeing prices going up in our supermarkets. Also, the premium that I spoke about earlier on. Now, Tapiwa, just looking at that, the Reserve Bank then admitted that, and through the Monetary Policy Committee, they came up with certain measures that they believe would stabilize the exchange rate. Let's start with the decision to increase interest rates from about 20% to 35%. Looking at that measure, is it something that can then reverse the instability that we're witnessing in the market?
I don't believe so, because they are actually addressing the wrong symptom, in my view. Like I said, that yes, in terms of borrowings, it will keep less people borrowing from their banks because it becomes more costly. And right now, those who already borrowed, they are now experiencing an increased interest payment. So obviously they will have to pass on the cost to their consumers, to cost to their customers. So prices already will also factor in that increase in interest. Then why I say that it's not the correct measure per se is because we go back to the issue of how did we get here, that you asked earlier. And I say that I believe it's the fiscal side that's causing all these problems to start with, because we are building, we are developing, which is a good sign. But the issue is now in the injection of of liquidity in the market when these payments are made. Yes, sometimes they say that they are phasing in payments, but mostly it's usually in bullet payments. And I go back to the RBZ when I say that their measures controlling the forex market are also causing this instability, because if they have that law that says that when a company has got its own forex and its nostril balances, it cannot go and participate on the foreign market. So eventually, these companies will just ask their customers to bring in foreign currency because they cannot go on the forex market, and this translates to the consumer as the market also rejigs itself. And we also know that the local companies are not allowed to participate on the foreign market in order to pay local commitments. So what next? They go to the black market, and that's why we had that increase in the parallel market, because the contractors that have been paid, they want to pay their local suppliers. They don't have the option to go to the forex market. They have to go to the black market in order to pay for their local supply. So that's I think that's the biggest challenge that we have. And if we do not address it, both sides, from the fiscal side and the monetary policy side, we will continue to increase interest rates, but have the same result.
So in a way, Tapiwa is saying that the instability that we witnessed has got nothing to do with those who are borrowing or the level of interest rates. Do you share the same sentiments, Gladys?
I agree with Tapiwa, because the new measure to increase the interest to 35%, it will only cause our inflation to increase even further. And it will continue to affect the consumers that the RBZ also seeks to protect. So in my view, the increase in the interest rates is going to be very costly, even to the businesses themselves. And it's also going to affect other businesses who will no longer afford to borrow, or their cost of doing business is going to increase. So we are also going to experience loss of production, which is also going to lead to unemployment in a way, and is going to continue to cause challenges in the economy.
Mm. So Tapiwa, another measure that was introduced by the Monetary Policy Committee is to increase reserve ratios from 15 and 20% to about 30% respectively. What do you think of that measure? Is it something again that you see taming price and exchange rate instability?
I don't believe so. Actually, it's going to affect businesses, and because they cannot, because the liquidity that's available for borrowing becomes, it's getting smaller. The cake is getting smaller, and in order for them to have, if they want to expand, let's say some are already doing capital expansion, it means that they have to look for a new source of money, and the only source that they have beside the banks is their customers. So they have to factor in the cost of the expansion in their products, meaning that inflation is going to continue. But I also understand this, the central bank in a way, although I would say now the reserve ratio is now not sustainable in a way. But their reason is that they want to avoid the situation that we had around 2016 to about 2018, that there was a creation of fake dollars in the economy. But at 15, I believed that they could achieve the same target. And at 2025, it becomes unsustainable even for banks to also make money in terms of their core business of interest earnings.
And they end up just looking at transaction charges,
yes,
fees, which they've been accused that they've abandoned their core business.
Yeah.
At some point when Tapiwa was explaining, ladies, I saw you nodding your head. But in this case, at this time, I want you to wear the shoes of the central bank to say, when they were putting up interest rates, when they were putting up the reserve ratios, what could be their rationale to do that?
Their rationale to do that is to manage the liquidity. They want to control liquidity so that they curb inflation, which is a noble measure. But in doing so, there are also risks that Tapiwa has alluded to. The risk of the businesses getting affected. It will come back again to loss of production. And our industries, especially those in the manufacturing sector, who rely on credit for expansion, we will see a reduction in production, which will now demand even our industries maybe to even import certain things that maybe they could afford to get locally. And in the end, again, the cost will also be passed on to the consumer. And again, our inflation will keep increasing.
Yeah. So before these monetary measures were made, obviously there was instability that everyone was seeing. And a lot of economists and analysts were pointing to the rigidity of the exchange rate. Now, as one of the measures, the RBZ came out and said it is going to allow greater flexibility of the exchange rate. Greater flexibility in terms of to what extent? Maybe what does greater flexibility mean to you? What do you expect when the central bank says we are going to put greater flexibility of the exchange rate? What do you think they mean, or what will be the ideal situation?
Thank you very much. I think that maybe they are trying to say that there will be accessibility in terms of the availability of foreign currency by the businesses, even by individuals. If I just walk into a bank, I should be able to get the US dollars that I need to do whatever business, to pay fees, or to do business that I want to do. Because the auction system, sometimes it was for certain businesses, certain people, it was not really for everyone. So maybe when they're saying greater flexibility, maybe they are affording a greater number of people to be able to have access to foreign currency, which is also currently in short supply.
Thank you. You are watching State of the Market, a program that is brought to you by the Business Weekly, which is a publication under the Zim Paper stable. Tapiwa, let me pose the same question to you. When the Reserve Bank says that it will allow greater flexibility of the exchange rate, what does that mean to you? Or what would you expect to happen?
What I expect to happen is that we are in a willing buyer, willing seller situation, according to the central bank. So I think, like any other willing buyer, willing seller situation in this world, I expect obviously to have a cap in terms of movement of the rate. But what I would like to see is that an exporter can name a price that he wants for his money, and a buyer can match that same price or bid at a certain price. And the central bank should allow the transaction to go. Because at the end of the day, there will be a balance. Things will balance themselves off. Those who pay greater, those who pay lower, will always have a median rate that we have. And at the end of the day also, it comes down to who's bearing the match cost. Is the seller selling at a higher price? Does he have takers? Is the buyer bidding too much, or is it bidding too lower? So I expect the market to be, in their own words, flexible in that regard. That people should be allowed to bid for any amount that they want, and people are allowed to sell any amount that they want at any price that they believe is the true price of the foreign currency.
So I think that's the interpretation that even the Bankers Association had in terms of the Reserve Bank saying you allow greater flexibility. I'm not sure if you saw the statement or from BIZ, Gladys, but in a way they were saying allowing greater flexibility of the exchange rate might have negative consequences. I think out of the 9 points that they gave, 8 of them were saying that allowing greater flexibility might result in price increases and volatility of the exchange rate. Do you agree with that analysis by the Bankers Association? And to you, when the banks come out and say allowing greater flexibility might not be ideal, what does that mean to you? What message are they putting across?
For me, allowing greater flexibility for everyone, I think why they are saying that there are going to be volatility issues, it is because there is less supply of the foreign currency. So in allowing greater flexibility, it will cause many challenges because there is limited supply of the currency. Now, when there is greater flexibility, it means there are now more players who have access to the foreign currency, but which is limited. So maybe they are trying to say that they want the exchange rate to be managed so that there is no greater flexibility, so that the lack of supply of the available foreign currency can be managed. That's how I would comment the BAZ analysis.
Yes, I had a conversation with the Bankers Association President, Lawrence Nyazema, and he said that as bankers, because I had asked him to say, what would you prefer? And he said a managed float. I don't know, Tapiwa, is that what is ideal for our market? And also maybe in addition to that, given what Gladys was saying, to say there are fewer sellers. In fact, we are only seeing the central bank coming through to sell foreign currency. What would make, and I think it's from the surrender portion, 25% that is surrendered. The other 75%, how do we unlock the other 75%? And why are exporters not coming through and also offering their forex earnings on the market?
To say that, yes, I agree that there's a shortage of foreign currency, but it's in relative terms, the foreign currency is there, What is not there is the correct price. That's what I would say. And because if I am an exporter and I have my foreign currency, I shouldn't fear selling it out, because knowing that at any given point in time that I want it, I can also buy it. And it is available to me
Real time.
in real time, maybe T+1 time or maybe the same day. So if as long as exporters cannot get back their money in such quick time, they'll always keep their money. Even if they don't want to use it, they always keep their money. And also the fear of the events that happened before. You can wake up like just last Friday, you woke up with 1 million, which was about 60 something thousand, about 64,000. Then at the end of the day, it's now worth about 43,000. So those issues, they bring about doubt in the people that are holding the foreign currency. So a managed float, yes, I would agree, because the central bank is the only player, as you mentioned. So if they can manage according to their reserves that they have, and if they can supply the market at the time that it wants the foreign currency, then I wouldn't mind a managed float. But I think the real issue is on the price of the foreign currency. The devaluation, everyone saw it coming because the bubble was just too big. They were concealing all the movements. I remember in one of the news articles, the governor was saying that yes, the rate is around 23, 24, but there are no trades that are happening at that point. But in real life, we also trades going through. There were confirmations that trades are going through. So that denial led us to that 43% devaluation. Had we left it to devalue on its own, I think maybe we might be around 1920 by now.
Gradual instead
Yeah.
of a shock. Maybe coming to solutions in the ideal situation. Gladys, given where we are, the RBZ has put its cards on the table to say this is what we think will stabilize the exchange rate and stabilize prices. If you are in the shoes of the central bank, what measures would you put in place? Maybe not only the central bank, but if you are in the shoes of both Treasury in terms of fiscal policy and the central bank in terms of the monetary policy, what measures would you put in place to ensure sustainable stability of the exchange rate?
Okay. From the fiscal side, I would say that measures to control government spending. I think it would be very ideal to control government spending so that we manage the stability situation. And also, when we come to the issues of the exchange rate, I would propose a liberal exchange rate. That would be my view. To have a liberal exchange rate where the market forces determines the price, because the issue is about pricing. Because we are having a situation where the exchange rate is like a controlled exchange rate. So that is why there are these price disparities. So I would say a liberal exchange rate, which is market determined, it would address all these price distortions that are available in the market.
I'll pose the same question to you, Tapiwa, as we draw close to the end of the program. What would be your solutions to the challenges that we have in terms of price and exchange rate stability?
On the side of the central bank, they are not so much. I would say that there is need to revisit, which I'm glad that the past president of CZI was saying that the discussion was had, that companies should be allowed to bid for foreign currency even if they have nostro accounts, nostro balances, because they have sometimes they are saving for capital expenditure. Since the interest rates are now high, they cannot just borrow and use. And they say that their members are saying that they only go to the market when there is a need for that money. So it's not like they're going there in order to store value, running away from the local currency. And I would also want the central bank to sort of let the market decide. I would go with Gladys on this one. Let the market decide. You know what? We are already on an experiment. Why not try the other side of the experiment? That's what I would say. We have tried the managed. Why not try the other side of the coin and see which one we can work with? Because we are already feeling the effects of the other side. And when it comes to treasury, I'll just repeat the same song that many of the business people and many of the economists have said before. Create more demand for the local currency. I hear the CZI was saying that payee should also be paid in local currency for it to increase demand for the ZiG. And I would also like the fiscal side to, being expansionary is not a problem, but let it not create new money. So I would say if they're going to do treasury bills, let them do treasury bills in foreign currency, because they already have a pipeline of those of that amount. They have the money. They are getting the earnings in terms of all our borders are getting money in terms of foreign currency. So let them not create new money through treasury bills in local currency. Let only the banks create money through loans, which is very small, because I think the local currency loans from banks are mostly for the individuals, which is consumptive as well. And so I think the fiscal side should borrow much in foreign currency to slow down the creation of money. Yes, money is created, but I think that side has much velocity than the other components.
Thank you, and that brings us to the end of today's program, State of the Market, where our focus was on the latest monetary policy measures that were introduced by the central bank. And to help me unpack that and come up with some solutions, I was joined in the studio by two economists. That's Gladys Shumbamiri Mutsopoti. Gladys, thank you for coming.
Thank you very much, Kudzi.
And I was also joined by the Business Weekly resident economist, Tapiwa Mangwiro. Tapiwa, thank you for being part of this program.
Thank you for having me, Kudzi.
That brings us to the end of State of the Market, brought to you by the Business Weekly, which is the publication under the Zim Papers stable. And my name is Kudzane Sharara. Thank you.